Welcome to Talk Tickers. We're the deep dive that gives you the strategic story behind the earnings calls, helping you really understand what's driving the market reaction.
And today we're digging into LyondellBasell, ticker LYB. Their Q3 2025 call was on Halloween, October 31st.
Right. And our goal here is, to cut through the numbers and the noise. We want to get to the core strategy, the management tone.
And figure out why the market reacted the way it did. Because it was, let's be honest, a bit of a confusing picture at first glance.
Absolutely. A big headline loss. But the stock actually ticked up pre-market, around 4%.
Yeah, about 4% pre-market. So the market clearly saw something positive beneath the surface noise.
Okay, let's start right there with that surface noise, the headline financials. Because they really capture the tension in chemicals right now, don't they? Between the cycle and the strategy.
They really do. So revenue first, it came in at $7.727 billion.
Which beat estimates.
Yeah, beat consensus by over $300 million. So better than expected on the top line. But still down 10% year over year. The cycle is definitely still biting.
Okay, down 10%, but beat. And the earnings. Specifically, the adjusted non-GAAP number.
That's where the beat narrative really comes from. Adjusted EPS was $1.01.
And consensus was?
Hovering around $0.0181. So a clear beat there. Pretty solid, all things considered.
Right, $1.01 versus $1.81 expected. But, sure. And this is the big but. If you just looked at the official GAAP number.
Oof. Yeah, the official GAAP EPS was a loss, a big one. Negative $2.77 per share.
Negative $2.77. How do you square that with a $1.01 adjusted beat? That's a huge gap.
It is huge, and it boils down almost entirely to one thing, non-cash asset write-downs. $1.2 billion worth.
$1.2 billion. Okay, so this wasn't operational underperformance driving the GAAP loss.
No, not fundamentally. This was management deciding to take a big accounting charge now. Cleaning up the books, essentially.
Cleaning up what, specifically? Where were these assets?
Primarily linked to their European petrochemical assets. It reflects a really prolonged downturn over there, the tough environment. Also, some smaller impacts from softness in the global auto industry supply chain.
So basically acknowledging that those European assets aren't worth what they used to be on paper, given the energy costs and demand issues.
Exactly. It's a non-cash charge, but it's a strategic signal. They're facing reality.
In the market. Liked this? They saw a $1.2 billion write-off and thought, good job.
It seems counterintuitive, right? But yes, because it signals they're serious about restructuring, about maybe exiting or shrinking in uncompetitive regions. It's the hard medicine investors wanted to see, rather than just hoping Europe bounces back quickly. It lends credibility to their focus on returns, not just volume.
Okay, that makes sense. Shifting focus from hope to action. So let's talk about the action investors did like, the cash story. Because that seemed to be the real positive driver here.
Absolutely. If Q3 wasn't about earnings growth per se, it was definitely about cash discipline. And the numbers here were pretty strong.
Talk us through it. Cash flow from operations.
Robust. Came in at $983 million for the quarter.
Nearly $1 billion in cash from ops. And the conversion rate. I heard that was impressive.
It was the star, really. Cash conversion hit 135%.
Wow. 135%. Remind us, what's their usual target?
Their long-term target is around 80%, so 135% is well above that, especially in this kind of market.
Why is that specific metric, cash conversion, so important right now for a company like LYB?
Because it shows they're managing the things they can control exceptionally well. Things like inventory, working capital, keeping costs tight. When your margins are getting squeezed by the market, strong cash conversion shows internal discipline. It proves they can generate cash even when prices aren't helping them, hitting 135%. That validates their whole strategy.
And this isn't just a one-quarter fluke, right? They have a formal plan for this.
Correct. They're on track for their 2025 goal, which is $600 million in incremental cash flow improvement.
Okay, $600 million for 2025.
But the ambition goes further. They're now targeting at least $1.1 billion in run rate cash improvement by the end of 2026.
$1.1 billion. That's a significant jump.
Yeah.
How are they getting there?
A big part is fixed cost reduction. They've already achieved $150 million year to date in 2025, so they're making tangible progress on taking costs out of the system. It gives investors confidence in future free cash flow, even if the market recovery is slow.
That focus on cash inevitably leads to the elephant in the room.
Yeah.
The dividend. It's yielding, what, around 12% currently?
Yeah, it's a massive yield. And yields that high always raise questions about sustainability. Is it safe? Are they sacrificing the future for it?
So how did management address that? They returned a lot of cash via dividends in Q3.
They did. $443 million went back to shareholders. And they defended it quite strongly. They laid out 4 key points.
What was the main defense?
The starting cash balance. They emphasized they entered 2025 with a $3.4 billion cash cushion. That's a significant safety net, built precisely for weathering these downturns.
The $3.4 billion cushion helps, but are they doing anything else structurally to protect that payout in their balance sheet?
Yes, and this was actually a very smart, proactive move. They renegotiated their revolving credit facility, their RCF covenants.
Okay. The bank loan rules, what did they change?
They got the banks to agree to raise the key net debt to EBITDA multiple limit. It went from 3.5 times up to 4.5 times, and that higher limit runs through 2027.
Why is that significant? Why do it now?
It shows foresight. They're anticipating that earnings, the EBITDA part of that ratio, might stay depressed for a bit longer. By raising the ceiling now, they avoid any risk of tripping a covenant later if the cycle stays weak. It protects their financial flexibility, signals commitment to their investment grade rating, and ultimately makes it easier to maintain that dividend without drama.
So managing the balance sheet proactively?
Yeah.
And what about spending? Are they cutting back on investments?
Oh, yeah. Aggressively. They cut the 2026 capital expenditure, the CapEx, guidance again. It was $1.4 billion. Now it's down to $1.2 billion.
$1.2 billion. And how does that compare to, say, their depreciation?
That's the key point. It's now below their depreciation and amortization expense.
Which means?
It means they're effectively underinvesting relative to the theoretical wear and tear on their assets. It's the ultimate sign of prioritizing cash preservation today over expansionary growth tomorrow.
They're making tough choices.
Like prioritizing certain projects over others.
Exactly. They specifically mentioned prioritizing MoReTec 1. That's their advanced chemical recycling project, high value. But they're delaying other projects like Flex 2 and MoReTec 2 until the market conditions, meaning pricing, improve. It's surgical.
Okay, surgically managing the finances. Let's look outwards now. Is the market actually showing any signs of life that might reward this discipline? You mentioned polyethylene, PE, demand showing green shoots.
There are some encouraging signs, yes, but management was very cautious, not declaring a turnaround yet.
What are the numbers?
North American PE demand, year to date, up about 2.5%. Europe, surprisingly, up around 3% in terms of volumes.
What's driving that? Still packaging. Packaging is resilient, yeah. But they also highlighted durable goods linked to electrification and digitalization trends. Things like EVs, infrastructure spending, data centers.
EVs. Do electric vehicles really use that much more plastic?
Apparently so. Roughly 10% more plastic by weight compared to a traditional car. Lighter components are key for range. So as EV adoption grows, it does become a structural tailwind for plastics, especially the higher performance ones LYB makes.
Interesting. But if demand is ticking up slightly, why aren't prices improving much?
The classic supply-demand story. The market is still trying to digest a huge wave of new global capacity that came online over the last few years. Until that excess supply gets absorbed or rationalized, even decent demand growth doesn't translate into much pricing power for producers.
Which brings us to what I thought was maybe the most significant long-term theme on the call. Capacity rationalization, this idea that supply is actually starting to shrink.
Yes, and the scale is really quite something. It seems to be accelerating.
How much capacity are we talking about?
The numbers mentioned were, well, announced closures plus anticipated ones. From 2020 through 2028, total over 21 million tons of ethylene capacity.
21 million tons. How much is that globally?
It's roughly 10% of total global supply. Gone? Or going in less than a decade. That's a massive structural shift, not just temporary downtime.
Wow. Okay. Where is this happening most? Is it evenly spread?
Not at all. It's concentrated in the higher cost regions. Asia is a big driver. South Korea apparently targeting up to 25% closures. Japan shutting 1.5 million tons.
And Europe, where LYB just took that big write-down.
Exactly. Europe's getting hit hard by energy costs and regulations. Management expects something like 20% of European capacity could eventually shut down. That $1.2 billion impairment is basically LYB getting ahead of that curve.
What about China? They mentioned anti-involution measures. Sounds quite philosophical.
Yeah, it's an interesting term. Essentially, it's Chinese policy aimed at improving industrial quality and competitiveness, partly by forcing out older, less efficient, high-cost capacity. In petrochemicals, it means the government is actually pushing for closures of unprofitable plants.
So China could actually help balance the global market by shutting down its own weaker players.
That's a theory. It should help significantly. The big question is always the timeline. How quickly will those closures actually happen? That remains a key uncertainty.
Okay, so long-term rationalization is happening, but near-term, management is still cautious. Their Q4 operational guidance reflected that, didn't it?
Very much so. They're actively pulling back production rates. In Europe, they're idling their larger Wesseling cracker, OM6, for at least 40 days in November, December, targeting only 60% operating rates for the whole European segment in Q4.
60% is low.
Very low. Plus, they're pushing ahead with selling those 4 European assets they mentioned, hoping to close in the first half of 2026.
And in the Americas, still strong there.
Stronger, but still cautious. They're targeting about an 80% operating rate in Q4, which is down about 5% sequentially. They cited seasonal demand shifts and managing inventory levels.
Even trimming in their intermediates and derivatives segment, too.
Yep. Idling one of the Channelview POSM units for 40 days, starting in November, aiming for a 75% operating rate for that segment.
So the message is consistent across the board. Write-downs, CapEx cuts, now operational idling. It all points to prioritizing cash and returns over just pushing volume into a weak market.
Precisely. It really reinforces the strategic pivot they're making, moving away from that old chemical industry mindset of volume at any cost
Towards
a focus squarely on returns and cash.
Yeah.
The write-downs, the willingness to idle capacity makes that pivot credible.
And underpinning this ability to make these choices is their core advantage, right? The U.S. Gulf Coast feedstock position.
Absolute critical. They hammered that point home again. The favorable oil to gas price ratio, which benefits U.S. producers using natural gas liquids, is expected to stay strong. They cited a range of 12 to 15.
And that means
It means their big U.S. facilities remain cost-advantaged compared to naphtha-based crackers in Europe and Asia, especially when oil prices are relatively high. It gives them margin support and staying power, while those higher-cost players are really struggling or shutting down. It makes LYB a likely winner in this rationalization game.
okay, looking forward then into 2026. If an investor is tracking this story, what are the key catalysts or milestones they should watch for?
I'd point to 3 main things. First, news on those European divestitures. Getting those closed in the first half of 26 and seeing the cash proceeds would be a big positive confirmation.
Okay, European sales.
Second, getting more visibility on the cadence of that $1.1 billion savings program. Are they hitting the milestones quarter by quarter? Execution is key here.
Makes sense. And third,
Watch for them to quantify the expected benefit from reduced maintenance downtime in 2026 and 2027. Less planned downtime means higher potential utilization and smoother earnings.
got it. Divestitures, savings execution, and maintenance benefits. Okay, let's pivot to our This Is Not Financial Advice segment. The outrageous pitch, given everything we've discussed.
Yeah.
The cleanup, the cash focus.
Yeah.
What's a potential trade idea here?
All right, well, remember, this is just a thought exercise, not advice. But you could frame LYB as a deep value restructuring story. They're taking the pain now, the non-cash hits, shutting down capacity.
To emerge leaner.
Exactly. And it's all backed by that massive 12% dividend yield, which management seems absolutely determined to defend.
So the pitch.
The pitch could be a pair trade. Go long LYB and short the broader material sector ETF like XLB.
Okay, unpack that. Why long LYB specifically?
The bet is on their execution. If they deliver on that $1.1 billion in savings by the end of 26 and successfully close the European sales, the free cash flow should be there to comfortably cover that dividend.
And the dividend acts as a support for the stock price.
A huge potential support, yeah. It could put a floor under the stock while they work through the turnaround, limiting downside risk compared to peers.
And why short the sector ETF, the XLB? What's the hedge?
The short XLB hedges against the risk that the overall chemical sector recovery remains slow and bumpy. The argument is that LYB's specific internal cost-cutting and restructuring plan, the $1.1 billion, can generate alpha, meaning outperformance, versus the sector average.
So it's a bet on LYB's self-help story outpacing a potentially sluggish broader market.
Precisely. You're betting on LYB's management executing their specific plan, insulating them somewhat from the slower, more volatile global capacity adjustments still playing out across the rest of the sector. It's an idiosyncratic bet.
Interesting. A disciplined thesis behind an aggressive trade structure. Okay, let's wrap this up. The key takeaway from LyondellBasell's Q3 call seems to be disciplined execution on cash and an aggressive cleanup of the portfolio.
Yeah, they're positioning themselves for 2026. Even if Q4 still looks tough, they're taking control of what they can control.
And maybe the final provocative thought for our listeners to chew on.
It really comes back to that global rationalization. 21 million tons of capacity potentially disappearing is, as we said, unprecedented. The big quarren is timing.
Specifically around China.
Yeah, how quickly do those anti-involution measures translate into actual permanent shutdowns of high-cost plants? And maybe even more critically, what oil or gas price point finally forces the remaining uncompetitive European players to capitulate for good?
Because that inflection point could really benefit the cost-advantage players like LYB.
It could turbocharge their North American margins if and when it happens. That's the major variable to watch heading into 2026.
Plenty to track there. Thanks for joining us for this deep dive on LYB. We'll talk to you next time on Talk Tickers.